Hello, everyone. Really nice to be able to do this session with you guys. As you know, for a few years ago, I actually was in Robert's role and worked with London Co-Investment Fund portfolio quite a lot. Fast forward, I have managed to survive Silicon Valley Bank. Now I'm bringing to the market a new fund focused on companies that are direct to consumer. This session is really, it hasn't been branded on purpose because I wanted to just provide you an impartial overview of all the debt solutions or the three groups of debt solutions you can find in the market for startups and scale-ups, and to just explain some of the more broader concepts and then the fine print. So if you guys are considering, accelerating in a different way, following the US model for many industries that is quite it's quite hard to manage without that in place, then you have all the information in one place. So let me just change my slide. Agenda is very simple. We're going to go through debt solutions. Then we're going to put it all together and see how it fits. So this is really a very simple case study just to show you a real company, how we would evolve in the US, what kind of products they would use throughout the life cycle. And then the final point would be, how can you plan? What should you be looking for, just in case you are considering some of the solutions? And does it mean to you? So those are the sort of finer prints and how you should be able to cope with the level of complexity that is thrown at you, even at the earlier stages. So why, when things fail to work, they do because we're often trying to fit in a round peg into a triangular hole, or a square peg into a round hole. And the reason for that is that we don't align the type of product that we want to use from the debt market to what we want to realize in our company. And that is the major flaw with selecting debt at early stage. But if done correctly, you could avoid some of these major failures. And the first one is the capital is not deployed and it doesn't help you realize the business goals or financial goals that you're driving with that facility. The second is that it doesn't align with your cash flow. And I cannot underestimate how important cash flow is for an early stage company. You guys know it better than I do. I've been advising and sitting on boards of companies for the last few years, worked with some of them through critical funding rounds, seed, Series A, from average investors and some of the top tier investors like Sequoia. So I think it's very important to pay very close attention whenever you're considering that at your cash flow. Why things don't work? Because the pricing is not clear to you, or is so complex that it's actually very hard to model. And many solutions have that characteristics right now in the market. It's too much management. That is another problem that many companies have, and that's why it doesn't work, because you spend too much time with your lender instead of your business. And the last one is that if you're going through a really challenging period, having that means that you have to restructure or go into default. So if it is a maybe you will fail, it will be a definite fail if you have the wrong product in the company. So these are the things that ultimately you have to avoid. But there's a silver lining, and I think that if you navigate this, and I'm more than happy to take any emails to explain to you some of these products inside out and to mentor anyone that wants to. I'm here just to help you guys, not to push anything at you in particular. So broadly speaking, there are three types of products. In the US market, there are hundreds of different products, but there are three classes. The first one is something that it's been labeled across the whole industry as venture debt. Venture debt, characteristically, with all the major suppliers and all the specialized funds in Europe and in the US and more globally, has a venture capital dependency. And I'll discuss with you what that is. But fundamentally, whenever you're thinking about venture debt, you should think, do I have a top tier investor? Do I have a VC investor that can satisfy that criteria? In the absence of venture capital investment in the company, there are some loopholes, and I will explain, but it's really very difficult to underwrite otherwise. Revenue-based lending. This is a solution that has exploded over the last 2 years in Europe. It's kind of old news in the US market. There are over 240 providers there. So revenue-based lending is basically a cash flow issue. It's underwritten based on your performance, your ability to deliver cash and grow that cash coming into the company every day. There's specific models that works very well, and we'll look into it. And the third one, in my view, is revolving credit. And this is really about the sales cycle and the user acquisition. So this compared to the previous two, this is a continuous line of credit, similar to an overdraft or a credit card that we might have as people. The others are term loans. And we'll discuss all these three, because I think if you master these three elements, you should be able to grow your company in a way that you have never done before. And I'll give you some real examples of companies I've worked with over the last 3 years that have managed to go from 1 million to 30, from 0 to 100 million in less than 18 months. And if you think that is impossible, I can really assure you that that is not. And that's my mission this year, to bring that awareness and to bring some of those founders out of anonymity into the spotlight, so that you guys can understand how they actually have done it. Okay, venture debt is the first product that you guys are going to experience. Fundamentally speaking, this is a very simple product to understand. It's a term loan. It can be up to kind of four years long. Is dependent on the pedigree of the venture capital fund, and usually is deployed at series A, B, and C. And it represents around 20 to 30% of your equity round. So if you're raising £5 million at Series A, it's about maximum of 1.5 million. If you're raising 10 million, it's maximum of 3 million. If you're raising a 20 million Series B, then naturally that will be somewhere around kind of 6 million. It is almost impossible in our industry to underwrite this type of loan, because all the funds in the market, from Silicon Valley Bank to Hercules to Columbia Capital Partners to Krios, everybody in the industry that you guys can pick up the phone and call right now, or send an email or apply online, all of these guys are going to look at who is your investor, who is going to step in and help you restructure this or give you more capital if you get into a challenge. In the best of the cases, what you will find is that the lender has already pre-existing amazing relationships with the venture capital funds. So while they're underwriting, while they're looking and assessing your company, they'll actually pick up the phone and have a conversation with your VC and ask them why they've invested, and ask them about the cash allocation for the company, and ask them about what their predictions are. And how reliable are your projections for the first, second, third year. So this is a very interesting way of thinking about debt in general, but fundamentally, most of the providers don't look at you as the company as the source of cash when things don't go well. They look at a third party, and that is the VC fund that has substantial capital and has done business with the lender before. So this would be the case of Index and Silicon Valley Bank, Index and many other, Sequoia, Insight, and many of the large multi-funds that are out there, they will have those legacy connections. So just putting it on a timeline, with this type of loans, you're probably going to get a facility, a very large facility. This is the yellow arrow going up, that is going to be given to you right up front. So you now have completed all the details, you've gone through due diligence, you've gone through KYC, you've gone from AML, you're all ready to go. The credit committee has approved it, and you have the facility. So now you can spend it. The most exciting thing about this is that you could have maybe periods of no interest or only interest. This period could be between 3 months or 12 months. So if you're still in the process of maybe finalizing or bringing a new product or updating the product offering, or you want to be able to have this buffer where you can hire people after your Series A or B or expand into a new market, then the best part about this product is that it offers you an ability to have all the magic, all the flexibility that you want. So it's fairly large in size, and then it's very easy for you to manage this period of maybe no interest or only interest periods, where you could do things that are business critical to enable you to then go to the market. But once this is done, one of the things that you will find is that you have a straight amortization. So amortization is really the period where you pay back the loan. And that starts, and that can be anything from 18 months in the smaller facility. So let's say that you want to be able to clear it off because maybe there's a much larger round that you're targeting. Maybe you just don't like debt so much, or this is more like a security for you. You just want to have those couple of million set aside for things that are unpredictable. And it can extend up to about 4 years. I haven't seen anything beyond 4 years, but I'm sure that it might be in the market. Okay, so then you start paying back. And these are the yellow arrows going out or going down. So this is, you're going to start to pay straight away the interest applicable to the facility, and of course the principal. And this is something that you have to model very clearly, because while it's really nice and pretty for the interest only or no interest period at all, and it could be 3 months, it could be 12 months, it starts to kick in straight away. So your cash in has to always enable you to cover your OPEX, and it always has to enable you to cover your loan payments. This is a fairly large market, is highly competitive. Interest rates are usually between 6 to 18%, depending on the provider, depending on your VC, depending on the risk profile. It has covenants, so there's a certain level of debt to income ratios that you will have to maintain. Breaching those covenants triggers, default or restructuring, which can be very punitive and very complex for companies that are still not that sophisticated, even at Series A. And finally, it has a number of fees, which you can be very confused by, because it's not just the interest rate. You have a setup fee that could be, depending on the provider, maybe 1-2%. You have a final fee at the close with the last payment that could be, in some cases, 0. If you negotiate very well, in some cases, it could be 1%. And the legal costs, because this is not a copy and paste exercise, are still between 10,000, maybe up to 25,000, depending on where you are, depending on your lawyer, depending on a number of complex issues. So this is, in all fairness, something that you should consider when you have a very, very clear purpose of what you want to do with it. And we'll look at a purpose afterwards in just a few slides. The second solution. So second solution is revenue-based lending. You guys have heard about it, is everywhere, and we know because some of the people in our industry have done an amazing job informing the ecosystem across Europe. about the benefits of revenue-based lending. To put it very simply, this is a short-term loan. It has been created many, many years ago in the US market for exactly that purpose, to help people, founders achieve very short-term goals. This is not like venture debt. You're not going to amortize it over a long period of time. If you're thinking about venture debt, venture-based lending in that way, then you shouldn't. And I've seen up close a number of the providers in the market. Obviously, I'm very aware of this because I'm bringing something that is competing with revenue-based lending. So naturally, I know quite a lot about it, the intricacies of the product itself. So it's amortized straight away, or is deferred, but it's priced differently. So be very careful whenever you're considering this, because if you need that buffer in the same way you wanted with venture debt, you're probably going to be punished for it. It's easy to underwrite, and there are multiple providers right now in the market, but they all have different formulas. And it's not suitable for specific things, not suitable for limited partnerships, not suitable for non-resident directors or owners, not suitable for existing secured lending. So if you already have a debenture over the company, it's not suitable. And now let's look at how it manifests. So let's say that you take 100,000 revenue-based lending, which could be a 1.5, 2 times your monthly revenues. That is the blue arrow going up. Plus you have the fee accumulated on top straight away. So even if you use it or you don't use it, that is accumulated straight away. So if it's 6%, then you will have £6,000 on top added to be paid immediately, the moment you signed virtually on that virtual dotted line. And then what happens next? Let's see. Because it's revenue-based lending, you will be able to pay out of a percentage of the revenues straight away. So 30 days later, we have your monthly revenues, and let's say that you've been given 25% of revenue as a fee. So month one, maybe you're making 50,000 of revenue, and you pay 25%. That's 12,500, so it's pretty good. If you actually have channeled this capital into marketing activities, and now your revenue is going up, or you're on a upward trend, your product is very popular and you're doing exceptionally well, then that could be a significant percentage of your inwards capital. And then month two, again, your revenues might be going up because, again, you're selling, you're in the market, you're doing everything to improve your business. That 20% of your revenue, now it's a little bit bigger. So, and then month three, again, your revenues are going up, and that is the whole reason why you have been given a facility, because you are on an upward trend, you're popular, you're doing exceptional things. But now the 20% is a little bit bigger again. And fundamentally, then you have this kind of residual payments, because the product has been underwritten and created to amortize straight away, to be able to pay it back within 3 to 4 months, the vast majority of the capital that you have taken from the lender. So that is how the product has been created, and that is how the vast majority of decision engines in this industries are coded. So you have growth before you apply. They see it, they create a sort of month-to-month model, they're able to underwrite on that model. So if you're growing at 10, 20% month on month, you're very, very fortunate to be experiencing such growth, then of course you're going to be able to access this very quickly. But the vast majority of the amount that you're paying, actually you're paying in the first 3 to 4 months. And then whatever happens, I call it residual payments, because they're going to be very tiny increments just to kind of settle the loan. The whole idea with revenue-based lending is that you take many of these mini loans throughout the year. That is how it works for the lender. And that is why some of these lenders are very successful, because you just don't understand the mechanism behind it. They're positioned as fixed fee, and I have a problem with fixed fee because fixed fee is a very simple way to create an optical illusion for founders. So actually, if you continue to take this kind of mini loans throughout the year or increase it and then accumulate that fee, which you pay straight away, in effect, you end up spending somewhere between 18% and 48% on your facilities. There have been a number of founders that have put their kind of calculations online. I know you have the flexibility and the impression that you can pay continuously forever from your revenues if you're doing well or not. There is another problem here with this one, which we have experienced in our portfolio of companies. And that is that if you have a bad month, yes, you pay less to the lender, but you will have less for your OPEX. So it means that if you don't have a cash buffer, you're going to get into a situation you might not be able to pay your salaries or providers or suppliers. So think very carefully and try to model the decision in the worst case scenario that you pay this in the first 3 to 4 months, and then see whether this is the right solution for you. There is a lot of flexibility in the space, but it will cost you. So the fixed fee goes up from maybe 6% to 12% if you want to have that kind of gap in between. So this is revenue-based lending. I know it appears simple, but trust you me, is nothing to like. The complexity behind is just hidden from you. So debt solution number 3, this is revolving credit. This is something that we have used from, I think, the moment that we were 18 as a credit card or overdraft. So it's a very simple product, but often misunderstood. So sometimes you kind of ask yourself how companies get from seed to Series B in kind of less than 2 years, because they use some of these products, which are not in our market straight away. Similar to revenue-based lending, they provide a multiple of your monthly or annual revenues. But instead of a term loan, is a credit line. A credit line compared to a term loan means that you can continuously draw down in different levels as you wish throughout the duration of a facility. Those facilities can be 24 months, it could be 3 years or 4 years. So it doesn't matter what the length of the facility is. I mean, how many of us have credit cards? Do you look at the contract, how long it is, the contract? Usually there is a term there, but it tends to roll over. So it's similar to that. Unlike the revenue-based lending, the multiple is substantially higher, which means that the facility size compared to the revenue lending can be quite substantial. A company with 50,000 of revenue maybe gets 100,000 on revenue-based lending because it's seen as a short-term product. Revolving credit or credit lines actually are seen as a long-term product because you can have it over a period of 2, 3, 4 years. So naturally, that facility can be quite substantial. Maybe it's $250,000. That is, I think that optically that is quite a lot compared to 100,000 for a small company. What it enables you to do, so this is the quirk for products like this. While it can be very large compared to revenue-based lending, and it can scale quite easily without you having to go through underwriting and tedious processes, is actually very dedicated to specific purposes. There are a number of providers in the US market. There's some that have entered our market that provide this type of solutions. And their mission is to help you generate revenues, because the whole purpose of a credit line is to enable you to get from one point to the next on your revenue growth journey much quicker. That is the whole purpose of it. So this could cover anything from digital marketing to inventory to digital asset creation to TV advertising. It could even have an element of working capital there, but that would be probably very, very small percentage in some of the cases. So this is very specifically created for growth. This is what companies like Flair Co, that's their mission, to be able to get you from a million to 20 to 30 to 100 in record time. The interest rates are slightly better because they're very transparent in at the onset. So you don't have this challenge of, oh, I'm drawing down 50,000. I don't know when I'm going to be paying back, so I don't know the analyzed fee, annualized interest rate of that capital that I'm deploying. Actually, this is upfront. It could be anything in our industry from maybe 10%. Companies that are much larger, much more mature, kind of Series B onwards, they'll be able to access much better rates than 10%, but those are going to be tens of millions in size. And they could go for very early stage companies, so maybe 25% in the worst of cases. The best part about this is that you have flexibility. So you have a cycle, and if you align this cycle of payment with the cycle of your sale or the way you acquire user or clients, it can be really powerful. This product, it works if it's structured based on the blueprint of your business. It doesn't work if it's just a simple credit card you can have with one of the American banks that allows you to pay 40, 50 days later. Your business cycle and your cash flow cycle might be a bit longer. So always think about products in a way that it works for your business. So let me just give you an example here. Let's say that we have a credit line. Let's say it's 100,000 again. Month one, I want to draw down something. So I'm drawing down in month one, and I'm paying maybe 3, maybe 5, maybe 12 months later. So you can see that actually, as a business, I can deploy the capital, I can make it work, I can realize the revenue, and only then I'm paying it back. The interest is only accumulated on what I'm actually utilizing from my credit line. Month two, I may want to do the same thing, but I may want a different amount. Maybe I want 30,000 instead of 20. And again, the cycle starts again from maybe 3 months, maybe 12 months, depending on how the line is structured. I'm paying back. Month three, last example, I may, want to just take £10,000, or I might want to take nothing. But fundamentally, these are kind of every time you draw down, you have this mini cycle that starts over and over again. If this is deployed correctly, that is how you get from A to B. That is how you get from tens of thousands of revenue to hundreds of thousands of revenue. But this is almost like a very specific purpose type of credit, which enables you to get there faster. So now that we've gone through the products, I just wanted to just show you how everything comes together. And this is a simple case study. And if you guys have questions or something that I've saved some time so we can go through it, and I'm more than happy to have half an hour with everyone whenever you guys are available. So I know Robert and Bianca can share my calendar with you guys. But basically, let's now look at how it works together. Research shows across venture-backed companies that about 50-50 of the capital is equity and debt from inception to exit. So if you want to be able to replicate the companies that actually have realized a successful exit, it's clear that you can't do that with just equity. Growth is not possible because the growth that the top tier companies in our industries have realized is unmanageable. Just to give you an example, I know that Robert will have several examples in his portfolio right now, but I work with some of the companies from Funding London in my SVP role, and I've seen them going from millions to tens of millions in the space of less than a couple of years. You can't realize that without potentially a bit of luck, but without utilizing capital in the most efficient way for your business and crafting products that work for you. So this has not been possible in the US for a long period of time. It's just still a culture here in Europe that we just don't like that. The challenge is, in my view, assessing what product is used for what time and for what purpose. At different stages of your growth, you may need different products. There is no solution that works for everyone. Very few organizations have a one-stop shop. I think that there are some companies in the US that have managed to do this well, like Bravo, but in Europe, there is no one-stop shop, unfortunately. So let's look at a company from pre-seed to post-IPO, from early stage to much later stages. We start with a simple company, guys in a dorm, just putting up together something, or it's an e-commerce business. We can all start it. I know drop shipping is apparently bad, but I still see every week companies and founders that have managed to scale from 0 to a couple of million in record time. Fundamentally, vast majority of those companies, the moment they have maybe 20 to 50,000 of revenues, they will start tapping into user acquisition. This is very easy to underwrite. They might be able to get maybe 500,000 over a course of a year. So this could be many mini loans. This could be a credit line that is specifically designed. But fundamentally, vast majority of companies are starting to use this type of products much earlier on, smaller amounts, but much earlier on. And then as you're getting to Series A, now you have a serious VC investor, you're doing a couple of million of revenue, and your Series A is probably going to be somewhere around 7-10 million, potentially a lot bigger if you're in fintech or insurtech or deep tech, that justifies substantially larger Series A's. So then you're probably going to take alongside your VC investment maybe 1 or 2 million of venture debt to enable you to have that buffer to grow quicker, to be able to pay the best people in the industry to join you. Talent is really, really important and much harder to get than personally I would have ever thought. And then you're into kind of beyond Series B. Now you want to be able to increase your revenues from 5 million to maybe 10, 20, 30, 40 million. The challenge doesn't stop with Series A. Actually, it just grows exponentially. And the difficulty is beyond Series A, you can't really manage to sustain very simply that growth of 20% month on month organically. Actually, you have to invest a lot of money and a lot of multiple strategies to be able to acquire your clients or your customer, your users. So the bigger you are, the harder it gets to continue to grow at a very, in double digits month on month. There's some companies that have done it successfully, but that doesn't mean it has been easy. So this is where you might have an accounts receivable. As a SaaS company, you might want to have a credit line like Pipe. You guys know Pipe, a US competitor that just came into our market. They can provide millions of pounds to be able to release some of that cash up front so that you can push it into advertising, push it into acquiring new users. And as you're getting to Series C, so this is really when you're raising the sort of 80 million, 100 million, you might want to increase your venture debt from the sort of 2 million to 20 million. So now you don't have just 80 or 100 million, you have 100 to 120 million to deploy. And this is where you're expanding your team from a few hundred people to maybe over 1,000 people. So you need that capital to be able to sustain that growth. And as you're getting to the next stage, you might want to go and increase another facility. So you have maybe 10 million of accounts receivable. So maybe with the same provider, you have around 30 million to deploy. And this is the sort of profile of a company that is almost pre-IPO, because you have to get to to revenues of 100 million in record time. Companies from Series C to B to D will have to get to about 100 million in revenue to make that exit or the IPO. So it's very important to not forget the journey. It doesn't stop. The pressure doesn't stop. It's just the amount of money that you need to get from A to B that is really complicated. Um, and as you're approaching IPOs, these are kind of mezzanine facilities. These are products that are created to give you a cash buffer to prepare your company for listing of sale. So this is, slightly more complex finance, but as you're looking at the journey of, this is a real company, by the way. As you're looking at the journey of a company maybe raising more than 120, 150 million in equity. If you put it all together, they probably raised around 40, 50 million of debt alongside it as well. So yes, maybe it's a smaller percentage than 50-50, but this is the sort of standard route. This company didn't grow because of equity alone. It grew because it had probably another 40, 50 million to manage and accelerate that growth. So instead of getting there in 12 years, you're getting there in maybe 5 or 7 years. But that is what it takes for a company with this specific profile. And I think that fundamentally, it's about selecting the right products at the right time to help you achieve something that is very specific in your journey, whether it's increasing revenues, whether it's working capital, whether it's expanding to a new market and having like a security or an insurance policy in your bank account. So whatever the purpose is, it has to be clear and it has to align with where you are in your journey. So now I've just saved the last slide. Promise there's no more content. For success and the sort of blueprint, the small fine print of every lender. And this is something that you guys would have already experienced as you're looking at the market, but I just want to pick up some of the elements. Debentures and lender seniority is one of the sort of first things. Debentures is like the charge over the company. So if your company goes bust, the lender has a right to take all your assets. One of the most interesting elements, and I've seen it with a few lenders, is IP, security over IP. You guys have worked probably for years to build something that is proprietary. Your IP is the most important element of your business. Always be very careful. If you're planning to sell the company in the next year or two, if you're considering a pure kind of acqui-hire, maybe with a much larger tech company, if you have a lender that has a debenture, so basically the assets of the company, including the IP, are under the protection of the lender, you might have problems at the sale if the loan has not been settled, or if you're hoping that the loan will be settled at the exit. So I think be very careful with debentures, be very careful with security over your assets, and which assets are they really securing? Is it just a bank account? If it's just a bank account, so basically them having a visibility over how much revenue you're doing, maybe it's okay. If it's over all the assets of the company and explicitly IP, because that is what you're in the business of, then potentially, take it with a pinch of salt. Set some things aside if you can. This is still an ecosystem where you can negotiate stuff. So don't be afraid to pay attention to the small print, because in the small print, that is where you're going to find the problems. Personal guarantees and personal assets. I know as founders, we all have worked very hard to have anything to our names. It's very difficult when you have a business to mix these two things. I know that we're very fortunate in the UK to have jurisdictions where, as directors and major shareholders of companies, we don't actually, the debt of the company doesn't transfer to us. In other countries in Europe and in Canada, for example, your if you are a director of a company and the company goes in debt, especially if that debt is of a specific nature, maybe let's say to tax authorities, you personally then get liable for it. Here in our market, there's specific lenders that require personal guarantees. So this means that if the company is unable to pay for this because you're not able to increase your revenues, get to a point where you have enough free cash flow or raise another funding round, then you personally are going to be in the line. And do take this with as much as much caution as I could possibly advise you. Even Sibyl for lines over 250,000 required personal guarantees. So I would always try to protect myself from that. I think that businesses are created for a specific purpose. They're limited liability for a specific purpose. Ensure that if you're dealing with a lender that asks you for a personal guarantee, that you understand the mechanism, that they're regulated to have a recourse to your personal assets, so that you're not getting yourself into a situation where you just volunteer something to a provider that is not even regulated to do a recourse to you personally. FYI, there are a few providers in the market that do that. Then you have revenue shares and OPEX. And for me, this is an important one. I've seen it within our portfolio, and it's heartbreaking to see founders going to investors because they use the product that was not good for them and in a bad month not be able to pay salaries. It's heartbreaking for the founder, but it's more heartbreaking because they're losing and bleeding talent if the investors don't have the cash readily, days, to be able to pay, to invest in the company. And just consider you doing that, what is the value of the company then? If the investor has to give you money because you just manage poorly your finances. And by the way, these are companies that have accountants and part-time CFOs that have been in the industry, and they can still make mistakes. Just consider the product that you're using and the impact, and have a contingency. The most important one, and for me, is the purpose of the funds and the return on your investment. As and when I'm ready to start my own business, I wouldn't spend a single penny if I didn't know exactly what am I spending it on and what is the return on my investment. If I can't measure it, I'm not going to invest it. If it's about, let's say, working capital and I'm employing 2 salespeople so that I can accelerate my sales, what is the quota of those salespeople? If I'm channeling my capital for, let's say, from a credit line into digital advertising, what is my lifetime value? What is my average order value? What am I getting? Am I contributing to my profitability for every sale and every pound I spend? If yes, then that is a good investment. If it's sustained enough over a number of months, then that is a very good strategy. If it's up and down, not very predictable, it's very hard, then I would take it with a pinch of salt. I would take it incrementally until I get to a point where I know very well what is the return on my investment. Manage your funds as if you were investors, and you will avoid so many awful situations that could happen down the line. And most importantly, always have a contingency. I cannot emphasize how important it is to have saved money aside for maybe 2 or 3 months of your OPEX. This means your salaries for the people that you're taking on the journey with you. Having a bit of a few reserves for those very rainy days can help you manage and maneuver situations that might be unpredictable. And we've seen, as COVID came, how unpredictable and how quickly things can change. for the good and obviously for the worst in some cases. Um, so that for me is the sort of final points. And I think that you guys are, exceptionally bright and exceptionally smart in what you're trying to do and what you're trying to build. Finance is not rocket science. It's a lot, 10 times harder to build a platform and even a website than it is to understand this. You only need to kind of pay attention, actually read the documentation, and most importantly, reach out to the people that are here to support you, like Robert, like myself, people in our ecosystem that have just seen so much, and just ask for an opinion for two, for free. Ask as many people how they've experienced it, and then try to adapt whatever you're doing to your business. Don't take something that is off the shelf and it's very simple, appear very simple, but it's not very simple at all.